Okay. Good day, everyone. We are back. We are still on the same question paper, which is November 2022, and we are now doing question 1. We started with question 3, and then question 4, question 2, and we are now on question 9. Our aim was to make sure that we complete the full paper so that you are able to benefit and you know that we have done the whole of paper 1. So we are now proceeding to paper 1, the last question, which we'll be doing in this paper, which is November 2020 paper 1. That is question 1. And question 1 is based on fixed asset and statement of comprehensive income. Fixed assets and statement of comprehensive income. It's just fixed assets and income statement. Statement of comprehensive income is the same as income statement. These are financial statements, and remember, the financial statement are done or they are prepared at the end of the financial year. So it is important to note before we even start doing this activity that the end of the financial statement for this activity is 28 February 2021. So the end is 28 February 21. So if the end is 28 February 21, it then tells us that the beginning is the 1st of March 2020. Because the accounting period is the period of 12 months. So it started on the 1st of March 2020 to 28 February 2021. Very important to note the financial period, the accounting period, the beginning and the end. The beginning is the 1st of March 2020 and the end is the 28th of February 2021. So we are only dealing with the transactions which relates to that period. So we are required, 1.1, you are required to refer to information B for fixed assets. So it will be important that you have this question paper in front of you so that you are able to follow this lesson and you are not left out. So we are now on page 4 and 5 of the November 2022 question paper, accounting paper 1. So if you now go to page 5, there is information B there on page 5, and there is an extract from the fixed asset note. There is an extract there of the fixed asset note, and that is where we have our Roman figure 1, our Roman figure 2, and our Roman figure 3. Our Roman figure 1, we are required to calculate the carrying value. Roman figure 1, the carrying value of vehicles. Carrying value of vehicles on 1 March 2020. If you look at Roman figure 1, there is an extract there of the fixed asset note. And Roman figure 1, in that extract, it says we are required to calculate the carrying value of vehicles on 1 March 2020. So this one is straightforward because the carrying value, the formula of calculating carrying value is cost price minus accumulated depreciation. So it is just cost price minus accumulated depreciation. So we do have the cost price here. The cost price here is 460,000. The cost price is 460,000 for the vehicles minus the accumulated depreciation at the beginning. This is the cost price at the beginning minus accumulated depreciation at the beginning, which is 396,750 equals to 396,750 750. We want to calculate the carrying value at the beginning, and the formula is cost price minus accumulated depreciation. 460,000 minus 39,000, 396,750. 460,000 minus 396,750. The carrying value is 63,250. The carrying value of the vehicles at the beginning of the accounting period. Our vehicles were valued at 63,250 at the beginning of the accounting period. And we are done with Roman figure 1. And then we want to move to Roman figure 2. Roman figure 2, it is where we are required to calculate its depreciation for the year. Its depreciation for the year. And we are still on the vehicles. Depreciation for the year, and we are still on the vehicles. Its depreciation, we are talking about an asset losing its value. Fixed assets losing its value. So depreciation for the year for the vehicles. We must first look at which method are we using. Remember, there are two methods of calculating depreciation. One is the straight line method, which is the cost price method, whereby you just take the cost price, you multiply it by the percentage, and you get the answer. And the second method is the diminishing balance method, whereby you take the cost price, you subtract the accumulated depreciation before you can multiply by the percentage. So it means the diminishing balance method, you are calculating depreciation on the carrying value of an asset. That is why the diminishing balance method is sometimes called the carrying value method. So let us check on the method that you are using for the vehicles. It says here, the business owned two vehicles on 28 February 2021. The second vehicle was purchased on the 1st of November 2020. Vehicles are depreciated at 15% per annum on cost price. Now we have the method of calculating that they are using. It's 15% per annum on cost price. And this business has got two vehicles. There is a new one which was purchased, we are told here, the new one was purchased on the 1st of November 2020. So the one that was purchased on the 1st of November 2020, we do have it here. Let's start with that one so that we are able to calculate depreciation. Because if you have got two vehicles and the date of purchase is not the same, you cannot combine them and calculate depreciation at the same time. So we need to separate the two. So we have two vehicles. There's a new one and an old one. Let's start with the new one. Let's start with the new one. The new one, we have the amount for the new one under additions at cost there, where it's written additions at cost in the extract of the fixed asset. The new one, the cost price is 510,000. And the depreciation rate is 15%. So that's 510,000 multiplied by 15%. 510,000 multiplied by 15%. And we also need to calculate the number of months we have used this vehicle in this accounting period. This vehicle was purchased on the 1st of November 2020. So our accounting period ends on 28 February. So it is therefore November, because it's the 1st of November. We are counting November, December, January, February. We have only used this vehicle for 4 months in the current accounting period. So it will be 510,000 multiplied by 15% multiplied by 4/12. Because 15% is per annum. So if we can just say 15%, we will get the annual figure. But because we have only used this vehicle for 4 months, it will be 15% multiplied by 4/12. So we'll get the correct depreciation of this new vehicle. Let's calculate it. 510,000 multiplied by 15% multiplied by 4/12. So the depreciation for this vehicle is 25,500. And now let's go to the old one. The old one, the cost price is 460,000. The old one, the cost price is 460,000 and the depreciation rate is 15%. $460,000 multiplied by 15%. 460,000 multiplied by 15%. 460,000 multiplied by 15%. Oh, right. We are using the diminishing balance method. This is the cost price method. Let's go and verify the method. The business owns 2 vehicles. Vehicles are depreciated at 15% per annum on cost. Yes. We are using the cost price method. So for the old one, it is 460,000 multiplied by 15%, and we are getting 69,000. We are getting 69,000. But remember, the old vehicle, we have already calculated the carrying value of the old vehicle here. That is information 1. The carrying value is 63,250. So you cannot have depreciation for this year, which is 69,000, which is more than the carrying value. So this is then telling us that this asset is now fully depreciated. The value is 63,250, but now the depreciation for the year is supposed to be 69,000. And if we can still depreciate it by 69,000, it will mean that this asset will end up having a negative amount. So what do you do when in this situation? You just ignore the 69,000 we have just calculated, and you come up with a new depreciation. You take the carrying value, which is 63,250. The carrying value, which is 63,250, you minus 1, and that will be equal to 63,249. So the depreciation for this old vehicle will be 63,249. So then the total depreciation will then be a combination of the new vehicle for 25,500 plus the old vehicle, which is 63,249. 63,249 equals to, let's calculate this depreciation. 25,500 plus 63,249. 25,500 plus 63,249 equals to 88,000. 88,749. 88,700. So our depreciation, this is the final answer. Our depreciation for the year for the vehicles is 25,500 for the new vehicle plus depreciation of the old vehicle, which is 63,249, and this gives us the total of 88,749. So we are done with the vehicles. And remember, this depreciation is going to be transferred to the income statement, and we have it in the answer sheet. This is the answer sheet that will be given in the exam, and I've decided to draw it here on the board so that you see what you may expect to get when you are writing it. So the answer sheet is provided with the statement of comprehensive income statement. So that is why it is important that as soon as you have calculated the amount that you will use in the income statement, you need to transfer it. So this depreciation is here. Depreciation, the total is 88,749. And there is also depreciation on equipment, because this business has got two fixed assets here. There is vehicles and equipment, and depreciation for equipment has already been given, which is 31,281 plus 31,281 plus 31,281. So that's 88,749 plus 31,281. All right. Okay, let us continue here. We will come back to the income statement. We are just transferring that this total that we are calculating here will be used in the income statement. So we decided to transfer as soon as possible before we even forget. Now, that is the reason why they provide you with the answer sheet, because they want you to make sure that as soon as you finish doing the calculation for something that is required in the income statement, you then need to transfer. Right. Then let us then continue. Roman figure 3. What is it that is required of us in Roman figure 3? Roman figure 3, we want to calculate disposals at carrying value for equipment. Disposals at carrying value. Disposals at carrying value for equipment. We want to calculate a disposal at carrying value for equipment. There is an asset that was sold. Let us look at the transaction which talks about this. Equipment. Depreciation, that is page 5, where it says equipment. Depreciation is 20% per annum on the diminishing balance method. Unused equipment was sold for 40,000 on 1 October 2020. Accumulated depreciation on the equipment sold was 36,600 on 1 March 2020. So we know that the formula of calculating the carrying value is cost price, the price that we paid when we were buying the asset, minus the accumulated depreciation. As we have been using the asset is depreciating, then you get the correct value. So let us then check the cost price of the asset that we are selling. The cost price of the asset that we are selling is not given here. And then that then requires us to look deeply into the extract of the fixed asset note. We do have the cost price for equipment at the beginning, which is 360,000. And the cost price for equipment at the end is 285,000. So we need to compare those two cost prices. If the cost price at the beginning was 360,000 and the cost price at the end is 285,000, so it then tells us clearly that the cost price of the asset that was sold is 75,000. The cost price of the asset that was sold is 75,000 minus the accumulated depreciation. But the accumulated depreciation that we are given here is not on the date of sale. The accumulated depreciation of 36,600 given, the accumulated depreciation of 36,600 that is given here is not on the date of sale. It is not on the date of sale. We are told that the accumulated depreciation on the equipment sold was 36,600 on the 1st of March 2020. So we have used, this asset was sold on the 1st of October. So we use the asset from the 1st of March, which is March, April, May, June, July, August, September. We use it for 7 months and we sold it in October. So we need to calculate depreciation for 7 months. So using the diminishing balance method. So if we are using the carrying value method, which is also called the diminishing balance method, at 20% per annum, so it will then be 75,000 minus the accumulated depreciation of 36,600, right? Multiply by 20% equals to multiply by 7. We said it's 7 months, 7 over 12. That is giving us 4,480. That is giving us 4,480. That is giving us 4,480. So the 7 months, the depreciation for the 7 months that we use is 4,480, which then brings the total depreciation up to, this is 75,000 minus 36,600 plus 4,400. This is 4,480 plus 36,600. 36,600 plus 4,480. This is giving us a total of 41,080 equals to, let's get to the answer. So the carrying value for this asset, the updated one, because this depreciation 36,000 was at the beginning of the financial year. We used the vehicle for 7 months, and then the equipment. We used the equipment for 7 months, and then the depreciation increased. It then depreciated by 4,480. So now the accumulated depreciation has increased to 41,080. So we need to calculate the value of this equipment so that we know that it was supposed to be sold by how much. The value of this equipment, the cost price of the equipment is 75,000, and the depreciation, the accumulated depreciation is 41,080. 41,080. Which gives us 33,920. The carrying value of this asset is 33,920. The carrying value of this asset is 30. If this asset can be sold by 33,920, it will mean that the business will neither make profit nor loss, because this is the correct amount for which this asset is supposed to be sold. But if you look at the transaction here, the transaction here tells us that this unused equipment was sold for 40,000. And this now takes us to the question, which is 1.1.2, where we are required to calculate profit or loss on the sale of the equipment on the 1st of October 2020. It takes us to this, where we need to calculate a profit or loss on the sale of equipment, on the sale of equipment. If you look at the price, this equipment was sold for 40,000. It was sold for 40,000. But the carrying value, the value of this equipment, the correct price, the correct amount at which this equipment was supposed to be sold for is 33,920. So the selling price compared to the value, 33,920, is telling us that we have made a profit, so we can confidently struck off this loss. We made profit. There is profit on sale of an asset. This equipment was supposed to be sold for 33,920, but we sold it for 40,000. The carrying value is 33,920. The selling price is 40,000. So 40,000 minus 33,920, we made a profit of 6,080. So the business made a profit of 6,080, which is an income to us. This profit is an income to us. And remember, in the income statement, there is a space for incomes where we need to record the income. So here you have your other income, right? So you have your carrying value here. You have your carrying value of 33,920. The selling price is 40,000 minus 33,920. So this business has made profit of 6,080. So under your other income, you have your profit on sale of an asset. Profit on sale of an asset. And this profit is 6,080. It's an income to the business. The business, your other income, this is an income to us, which is 6,080. Remember, I told you, even when we were doing depreciation, that it is important when you are doing this calculation, whatever that is going to affect the income statement, it must be transferred immediately before you even forget that there was such an item. Right. Then 1.2.